I've got 3 reasons why you can beat the stock market by following stock market news. I'm busting one of the oldest myths of investing, the efficient market hypothesis, and it's going to change the way you invest. We're talking beating the market today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Our 2019 dividend stock portfolio is up over 24% so far this year, beating the market by more than 10%. And I've been following a lot of the stock market news lately, thinking that the downside looks a lot worse than the upside for the rest of the year. So I'm putting this video into our 2019 Stock Market Challenge playlist. So if you haven't seen those other 3 updates, check those out. Along with some of the biggest investing channels here on YouTube, I've created a $1,000 portfolio in January and will be tracking it all year. Now, to track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits across the group free of charge. Now, the long-term investors and those believers in the efficient market hypothesis would say, don't worry about the stock market news. You can't beat the market because everything is already priced in, so just hold on and enjoy the ride. But I don't believe it for a second, and I'm going to give you 3 reasons why I think you can beat the market. I'm going to first update you on our 2019 challenge portfolio, look at a couple of the stocks in that portfolio, then I'll explain the efficient market hypothesis, what it means, and why it's busted. Stick around because how we look at that is going to mean big changes in the portfolio going forward and will affect the way you invest for the rest of the year. We'll get to that update, but first I want to get your opinion. Do you think investors can beat the market? Why or why not? Don't let my opinion sway you. What are the reasons you believe investors can or can't beat the market? So scroll down and tell us in the comments section below. So we started the 2019 Stock Market Challenge just a few months ago, and it's already rocketed over 24% higher. That's compared to a return of 14.2% on the broader stock market and 13.1% on the Vanguard Dividend Appreciation ETF, which is a fund of dividend growth stocks I'm using for the benchmark index. Of the 11 stocks and funds in the portfolio, 8 of them are beating the market, with 5 doubling the market return. There are some real standouts here like China Life and General Mills, both up around 30% on the year. Our ConAgra position we just added in February, and if you remember, I said I thought management was being overly conservative on its revenue forecast for flat or down as much as 5% for the year. Then what happened when they reported fiscal third quarter earnings in March? Organic sales were up 2%, boosted by both volume and higher profitability, sending the shares up 20% in a single day. So I'm sitting here thinking, man, 24% in 3 months is pretty damn good. In fact, the S&P 500 has only produced a higher return in 8 years out of the last 27, going back to 1988. And I look at some of the stock market news like slowing global growth, a European economy that's near recession, a US consumer that's tapped out on debt, and I wonder if it's not time to take some of these profits. In January, I pointed to a US-China trade deal as a major reason for optimism, but I think even that is priced into stocks at this point. So my gut is telling me to sell into this strength, to take some of the profits and sit out what could be a bumpy market for the rest of the year. Now that intuition runs face first into what's called the efficient market hypothesis. Now I have to go a little stock nerd on you for a minute, but stick with me because where I'm going with this will affect the way you invest. Now the efficient market hypothesis is just a theory developed by Eugene Fama that says you can't beat the market because stock prices already reflect all available information. Basically, it says there are so many people in the market, in the stock market, trading, watching that information as it comes out, that prices automatically adjust, so there's no point in doing analysis or strategies. There are actually 3 forms of EMH that say different levels of information are baked into stock prices. You've got the weak form that says all past prices and patterns are known, so you can't make money predicting future patterns. Here they're saying that traders investing on technical signals can't beat the market. There's also the semi-strong form that says all past information and current information that's publicly available is baked into stocks. Here they're saying that analysis and stock picking to find stocks that beat the market is pointless as well. Now finally here you've got the strong form that it says even non-public information is baked in, so even insider information is already reflected in those prices. Now while there is a lot of research to back up that first form, that technical trading strategies don't work, the jury's still out on whether you can beat the market through analysis, and it's obvious that the insider information form, that strong form of EMH, is bunk because these jokers make money all the time front-running regular investors. Now we get to the 3 reasons why I think the efficient market hypothesis is busted and what it means to your investing strategy. Now, first is just the historical evidence of great investors like Peter Lynch and Warren Buffett. Lynch ran the Magellan Fund from 1977 to 1990, beating the stock market in all but 2 years and booking a 29% annualized return over the period. Of course, everybody knows Warren Buffett, the legendary investor leading Berkshire Hathaway, producing a 1,600% return versus less than 500% on the S&P 500 over more than 3 decades. Now, these billionaire portfolio managers use deep analysis and business experience to pick stocks and beat the market over those long periods. Second here is that we do see patterns, long-term market truths that investors can use to time the market, not from day to day or even month to month, but that do work from year to year. These are ideas like mean reversion, and this is the idea that hot-performing stocks tend to come back down to earth while the laggards tend to bounce back up. You see in this chart, based on research by Burton Malkiel of Princeton, in growth versus value stocks. Here you see that growth lagged and value outperformed for about 30 years to 1967. Then the trend reversed where growth outperformed for a decade. Now this is actually really interesting because over the last decade, since the end of the recession, growth stocks have outperformed and value has lagged. So a lot of investors are wondering when that might flip again and value stocks will start outperforming. Here, one of the most well-known studies is shown in this chart of future 10-year returns when stocks reach a certain price to earnings level. It shows that there is a predictable valuation trend the higher stocks reach on that PE basis, the lower future returns tend to be. By the way, currently the stock market is priced at almost 22 times earnings, so according to this, we'd be looking at an annual return of about 5% over the next 10 years if you bought in at this point. So we do see predictable patterns in the stock market, but I've got one more reason why the EMH is busted. The biggest reason the efficient market hypothesis is busted is because it's a market of humans and completely batshit crazy sometimes. Listen, I could believe that the market is efficient if it was run by machines, immediately computing through all the available information, but it's not. You only have to look at a chart of stock prices to understand that investors are completely irrational. Before that manic bubble pops and around those depressive lows, you can't tell me that a rational investor couldn't beat the market at these points. All this simply means is that you can beat the market. Now, before I get a bunch of hate mail, I'm not saying it's easy to do. Obviously, Lynch and Buffett have their big brains and armies of analysts that put in that work, but it is possible. For most of us, even the tired old analysts like myself, it means following the stock market news, doing your analysis, but also taking advantage of those long-term trends. Whether it's even possible to time the market from month to month, it'd be nearly impossible to do it on a research basis, but you can beat the market year to year by playing on these patterns and doing your analysis. We talked about some of those ways to analyze stocks in our live stream yesterday, and I'm planning on an entire series on fundamental analysis to give you everything you need to do this. I'll be starting with this series soon, so make sure you subscribe and click that bell notification so you don't miss it. I'm linking directly below to those first videos detailing how I set up our dividend income portfolio, that 2019 stock market challenge, and how you can set your own up. I'll also leave a link to M1 Finance, that no-cost investing platform that I'm using for the challenge. It's going to save you thousands of fees whenever you rebalance. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments. We'll make sure you get an answer in a future video.